Well, hello everyone, and hope you're all having a great Wednesday. We're broadcasting here live from San Diego, California, and we'd like to thank you so much for joining us tonight. My name is Jean McDowell with TradersCoach.com, and welcome to Wednesday Night Live. Well, ladies and gentlemen, I'm going to turn it over to Bennett McDowell.
Gene, thanks so much. Great to be here. Welcome everybody to tonight's webinar. Trade size really does matter, and of course we're going to talk about risk control and how to actually teach you how to implement a really good and solid risk control program or model into your current trading approach. I want you to think for a moment about trading and all the facets that are involved in being successful. You know, you have the psychology part of it. We have entries and exits. We have dealing with brokers, you know, having the capital. There are a lot of elements that we have to master, don't we, in order to be really good at this business. And I'm going to tell you, one of the most important is risk control. And so that's why I love to do this webinar, and we do it quite often. And one of the reasons we do is it's such an important topic, but you're not going to find it being taught that much out there because it's not really an exciting topic. So we're going to try to make it exciting. We're also going to give you some action steps that you can implement right away. By the time you leave this webinar today, you can start using it in your trading. So I want you to pay attention today. I want you to ask questions and stay to the very, very end because we're going to cover a lot of material today. All right, so let's get going here. First of all, Gene introduced me. Thank you, Gene. That was nice. And please, everybody, come to our website at TradersCoach.com. We have a lot of free information there that you'll find interesting on a variety of different topics. We also want to talk a little bit about the risk involved in trading. We have to do this, of course, before we do our presentation. And without that risk that we all know is present, but without the risk, there's no opportunity. So the two really go hand in hand. Just make sure you understand how to control the hard part, the risky part of trading. And that's what we're going to talk about today. So today we're going to focus on that risk that is in trading. A lot of the concepts I'm pulling out for today's webinar is also in my book, A Trader's Money Management System, available at all major bookstores, including Amazon. It was published a while back. I wrote it back in around, I think, 2008, and the concepts still hold today. And you can get this at Amazon, like I said, or Barnes & Noble. It was published by Wiley back in that time period. But a lot of the elements that we're going to use and talk about today are taken right out of this book if you want to learn a little bit more. Also, too, I've written 3 other books, so feel free to check those out as well, ranging anywhere from entries and exits to how to run your trading business from your home, just like a professional hedge fund, and also forms of technical analysis like Elliott Wave and so forth. Those are all available too. Now, before we get going, I wanted to reward everybody for being here and give you a free money management article. So go ahead and download this. Gene's going to put the link, okay, in the chat area. Gene also put the link for the Amazon or Amazon store if you want to pick up any of our books too. So that is in the chat area, and you can click on that, and that'll stay in there. And she also put the link for the free article that I wrote for Stocks and Commodities magazine. And in this article, we're going to have the formulas. We're going to go over the formulas today, but in this article is the formulas as well. So please definitely download that at this time and do that before you leave the webinar because you're going to want those formulas that are in there. All right, so again, this was something that I produced for Stocks and Commodities magazine. It's in a PDF file, so you can download it right to your desktop and look at it on your computer. Okay, so that's one thing I wanted to do, but the other thing I wanted to talk about a little bit is why? Why risk control and money management? Does anybody want to take a stab at that? Why do you need risk control and money management? Anybody? I'm going to make you participate, so you can't stand still and not participate today. Got to participate. All right? So you don't go broke, okay? That's good, Tiz. I like that. Anybody else? Because it's a business, right? Not a hobby. So you want to make sure you're in tune with it. Profitability, of course. It's hard to be profitable without good money management, right? and to manage the downside, right? So not every trade's a winner, right? So you got to manage that downside. And as Jack says, really it's the most important part of trading, and it really, really is. Again, I can't stress that enough. And I think what happens is when you first start out in trading, you really don't realize that. I know when I first started out a long, long time ago, I didn't realize much about risk control. And back in those days, the internet really wasn't around like it is today. So there was not that much information except for if you went to the bookstore. And so I learned about risk control the hard way. I basically lost a lot of money in the beginning. And what I'm trying to do with this webinar is get to you, especially you new folks out there, before you have to lose money to realize how important risk control is, right? And you veterans out there that have been trading a while, I know you know exactly what I'm talking about because it's happened to most all of us. So the idea is it's really important, okay, to control risk on each and every trade. It's going to be really the door, I call it the door between the novice trader and the professional trader. It's risk control. All right, so that's why. That answers the question of why you need it. Now your goal, okay, we're going to talk about those in just a minute, but you need to understand that when you enter a trade, how many of you have entered a trade you thought was going to be the sure thing? You ever enter a trade where just everything lines up, the stars line up, everything is perfect, so you go into the trade, all right, and you think twice, you know, well, maybe I don't need risk control because this is a shoe-in. And of course, what happens? All right, the trade fails. In fact, what's interesting is a lot of times I'll go into a trade that's marginal, and that trade turns out to be the best trade, whereas the ones I thought that were going to be the sure winners aren't as good. Okay, so that can happen as well. So, and you load up, like Andrea says, absolutely. All right, so we want you to have a systematic, structured approach that you're going to be able to follow, whether it's a trade you feel really good about or one that you don't want to miss, but you're kind of marginal on whether it's going to turn out good. We want you to be able to apply the same types of risk control strategies for each and every trade, so you cut your losers short and let your winners run. That's the goal, okay? Now, on our next slide here, as you can see, we're going to even mention that. That's your goal, all right? Keep your losing trades small and let your winning trades run. And you can only do this if you're using a systematic approach to money management, all right? And as Ron says, that's an understatement, absolutely. So I think we all realize how important risk control is. Next question is, now we got to make sure we're using it on every trade. And we don't want to make risk control such a burdensome thing. You know, have you ever read any books on risk control? They can be quite intimidating, especially if you talk about portfolio risk management and all this stuff. By the time you're into the second chapter, your head is spinning and you're like, geez, you know, how am I ever going to implement this? But what we've done, and what I try to do with all my books, is I try to take complex topics and simplify them enough so you're still protected, but at the same time, you can actually understand the stuff to implement it. So that's one of my goals when I write a book, is I try to simplify a complex topic so you understand it and actually can use the concepts in it. And risk control is no different. So today we're going to talk about a couple of things. We're going to calculate, learn some of the simple calculations involved in determining your trade size, which is a basic method of controlling your risk, and we're going to talk about that more. So we're going to calculate also your percent to risk. Okay, that's basically, you know, what percent are you willing to give back, and you shouldn't be throwing darts on a board for that. That's something that can actually be calculated based on your closed trades and so forth. So we're going to talk a lot about this stuff. One of the instruments you'll see is the trade size calculator, and the one we have now is an updated version, so it's not a square anymore. It's a rectangle that fits on your screen a little bit easier, but it does the exact same thing as the one in this picture. And basically what we're doing with this is we put all the formulas that are in that article I was talking to you about just a minute ago that you could download into the calculator, so you don't have to mess with them. It's very simple. You just plug in the numbers and we'll walk through some examples. But the idea is that when you can use the trade size calculator on each and every trade, then you're going to be able to calculate your actual trade size and the dollar risk. let's take a minute, since this is such a nice picture of the variables that go into the calculator, a little bit about what's important. Well, notice the first thing here is the actual account size. So this is going to be the cash value of your account. That goes into the account size. The percent risk, now, this is a variable that we can actually change based on how good a trader we are. And we have another piece of software called the Trader's Assistant that can actually take a look at all your closed trades and deliver the percent risk to put into this trade size calculator. So that is available to you if that interests you. But for right now, for the example on this particular webinar, we're going to use 2%. And that's generally a rule of thumb that you'll read in most books. And actually a 2% risk in this box here assumes a system that's winning about 60% of the time, okay, and has a payoff ratio of more than 1-to-1, about 2-to-1. All right, so we're going to talk a little bit more about what that means in a little bit. But the 2%, if you have a system that's delivering this, then that's the right percentage to use. If you're winning more than 60% and your payoff ratio is 2-to-1, well, then you can trade with a little higher risk, okay? So we'll go over that in a little bit more detail, but that's one of the things you got to put into the trade size calculator. Then notice we have an entry and an exit price. We have a place to put commissions. All right, hopefully you're not paying $51 for commissions. You're not in full service brokerage anymore. Everything's pretty much online, so that's going to be a lot cheaper. And then we also calibrate the calculator for the point value. We also have the current calculator now that can be used for Forex market as well. But in these examples today, we're going to talk about stocks and futures. All right, so margin account, this is basically some brokers give you margin. So if you have a stock trading account, let's say it's a $50,000 cash account, which we put in up here. If you have a 50% margin, that means you can borrow up to 75, an extra $25,000 for a total of $75,000 you can purchase in stock on a $50,000 cash account. All right, so we'll talk a little bit about the advantages and the cons associated with that. And then basically when you put in these variables, the entry price, the exit price, hit calculate, it's going to give you some numbers down here. And these numbers basically are going to be the trade size, which is also known in the industry as the position size. So this is a maximum number, so it has 753. So in this case here, what that means is that we don't want you to go over 753 shares on this stock example, because if you do, based on the current price and where your stop and entry are located, your dollar risk, if you went over, would be more than 1,000, and 2% of 50,000, okay, is 1,000. So that's the most we want you to lose, and we're going to tell you a little bit more about some of the tables that substantiate that. Okay, so that's just a quick intro on the actual trade size calculator. Now, let's move on here and talk a little bit more about the significance of money management and risk control. Like I said before, we never know what trade is actually going to be successful or not. So when you have risk control, you basically are allowing yourself to be wrong without catastrophic consequences, right? And it helps control risk, takes into account that every trade can be a potential loss. Now, obviously, we don't want to go in with that attitude, do we, when we make a trade? We want to go in with an optimistic attitude that we've done the analysis and things look good. But we still, in the back of our mind, if we have that in place, if we think that every trade can be a potential loss, you're going to protect yourself and use risk control, which is the goal, because that's going to give you the structure to keep your losing trades small and let your winning trades run. And it really does separate the pros from the novices. Like I said before, it's that door that really separates professional traders from novice traders. And money management or risk control really becomes a state of mind, because once you feel you need it, you will use it. Problem is, most people usually suffer a large loss before they believe they need it. So again, the purpose of being here today, especially you new folks, is to really drive the point home that you need it, all right? And we want to try to help you get to a point where you believe you need it and so therefore you'll use it. You won't have that actual large loss. Okay, so I think that's really important as well. Now, when we talk about risk control, it can apply to all markets. Even option traders, okay, can use risk control all the time, and we have ways in which we'll talk to you about that in a little while too. All right, so let's keep moving on here. All right, so we've talked about why. Let's talk about some of the elements that are an important part of risk control, like how much risk, okay, to make on each trade. We're going to talk about that. Calculating the actual trade risk, calculating the trade size, we're going to go over that. And we're going to talk about risk of ruin. And, you know, you also have to have some form of effective stop placement on your charts. So when you trade, you have to have initial stops and trailing stops. So we're going to talk about that as well, okay? Now, without writing it down, you don't have to answer this, okay, in the chat area. I just want you to think about this. I want everybody to think of an experience, whether you're just starting out in trading or if you've been trading for a very long time. Think about an experience where you suffered an excessive loss because you didn't use risk control. Think about that. And perhaps think about some of the sleepless nights that you may have incurred during that period. And then I want you to ask yourself, why didn't you use it? Why didn't you use it? So I want everybody to think about that. And if you wouldn't mind now, I'd like you to, in the questions area, write down what it felt like briefly and write down why you didn't get out. Why didn't you use it? And you may simply have not known much about it. That may be the answer. You may have been married to a position and you just didn't think you needed it. All right, so a couple people are coming in with some answers here. All right, paralyzed with fear. I can relate to that. I can remember back in my early days of trading, I had an options trade that went against me, and I had lost more money in 3 weeks, and I had a job at that time than I made at my job. So that was pretty darn frightening, and it got so bad that I actually had a very hard time sleeping at night. So I think, you know, that taught me a lesson right there, that if you don't get a handle on the risk control, there's going to be problems, right? All right, so great answers coming in here, okay? Ron saying, because my chances were just not there for losing. Okay, yeah, option trade went against them. Overconfidence, yes, Tiz, good one. All right, paralyzed with fear, like I mentioned before, Andrea, excellent. Thought it would come back, Richard, excellent, because that is a very common thing. I always say, just to piggyback on that, Richard, you know, when you're a trader, okay, as soon as you have to hope something comes back, you've really turned into an investor. It's kind of like, you know, the problem is usually what we're doing is trading momentum stocks, right? So these are not investment grade stocks. So you don't really want to be an investor in momentum stocks necessarily, okay, because they're not good bet for the long term. Not all of them anyway. So what happens though when you don't get out is you're then married to that position and the loss becomes too large to actually take. So now you sit on it and hope it comes back, and that's not a good place to be. That's why you got to cut those losses right away. All right, let's see. Yeah, and John's saying ignorant at that point, okay? Let's face it, a lot of times when we first start out in an endeavor, okay, we don't know all the facets of how to do that particular thing we want to do. So we're kind of, you know, ignorant a little bit on that. And so these are really excellent and very real answers. And I think all of us have experiences like that. So that's excellent. So for those of you that are new out there, take it from all of us that you don't want to be in that situation because it doesn't feel good. Okay, it just doesn't feel good. All right, so let's move on here and see how we can protect ourselves now. So healthy money management, psychology actually, begins when you realize that each trade's outcome is truly unknown. No matter how overconfident you are, no matter how good you think that trade setup's going to be, no matter how accurate that Elliott wave looks like, all right, you always have to use risk control because everything in the markets is probabilities. Nothing is certain. So you have to protect yourself. Think of it like a seatbelt. All right, so profitable money management occurs, again, when you truly believe that you need it. Because if you don't believe you're going to need it, you're not going to use it. Okay? All right, so let's go on a little bit more now and talk about a couple terms here or definitions. Trade risk versus market risk. Probably some of you know what this is already because you've attended the client workshops and so forth that I do, and I do talk about this from time to time. But let me just hear from some of you out there what you think trade risk is and why it's different than market risk. So what are the two all about? You got trade risk versus market risk. Anybody? Okay, Andrea, let's say market risk can be the black swan event. Aha, yes. All right, it's that crazy thing that can happen every once in a while that causes the market to gap quickly past our very carefully chosen stop, right? All right, you can't control it, as Jerry says. That's right, 'tis. All right, trade risk is when your trade is stopped out, but it's not only that it's stopped out, well, that's trade risk, but with trade risk is when you stopped out in an orderly fashion, which is what you mean, okay? And as Jerry says, it's a controlled risk when you talk about trade risk. Market risk is the overall tide. Trade risk is the individual wave. Okay, all right, that's interesting take on it there. I like that, John. All right, each trade is separate and each trade is part of the market, which you never know. So when you talk about trade risk, all right, we're going to break it down here and how to control each different type of this risk. Basically what we're talking about is trade size. Remember we talked about calculating your trade size with the trade size calculator. Trade size, which is also again known as position size, that is the way we control our trade risk. The actual market risk is controlled by how much money or risk capital we have in our trading account that we can expose to trading. So this is exactly why even really great traders, we never trade our entire net worth. And the reason for that is because if you have a market event, let's say, you know, I've got my entire net worth invested in the markets, and I've got all these carefully chosen stops, and then all of a sudden a terrorist attack happens, and the market gaps down on everything. All right, I'm going to be looking at a lot of substantial hits, aren't I? It's kind of like the Titanic unsinkable ship. All right, it's sinkable. Okay, so you've got to be careful with market risk. So this is why you only want to fund your trading account with money that you can afford to risk, no matter how wealthy you are. Okay, I think that's really important. And, you know, we can spend a whole webinar alone on, you know, how to go through your net worth and determine what's appropriate. And again, we do address that in a lot of our materials and in our book. But for right now, I just want you to understand that trade size controls your trade risk and account size controls your market risk. Okay, next one. Has anybody heard of the word or term risk of ruin? And if so, tell me what you think that means. Risk of ruin. It's used in a lot of different games in Las Vegas, for example. It's used for portfolio management. It's used for a lot of things, actually. All right. What's the main thing you think about? Without thinking too much, what do you think when you think of risk of ruin? What is that? Okay, Andrea says it's bankrupt. Okay, cannot recover. Okay, likelihood you will lose your whole account when the equity is gone. Okay, so what we want to do here is take this concept that can really mean bankruptcy and turn it around and make it our edge. Okay, so we want to make the risk of ruin work for us. And it really, risk of ruin is one of these things that incorporates a lot of different variables. But one of the ways we do this is by determining proper trade size, risk percentage based off the risk of ruin tables. So I'm going to, before we go to those, let me just quickly also go over a couple concepts you're going to need to know. Have you heard of win ratio and payoff ratio? Type yes in the question if you've heard this, or no. Win ratio and payoff ratio. When we talk about managing risk in the markets when trading and determining our trade size, these are two very, very important terms. And they are somewhat married, so to speak. So let's go through these a little bit. The win ratio is very simply how many trades do you win versus how many trades do you lose. The payoff ratio is how many dollars do you make for every dollar you lose. That's the raw basic definition. But let's take a look and see what that kind of means for us. Let's take a look at the win ratio formula. So it's usually expressed in terms of percentage. So if I say, well, I'm winning 60% of the time, what that really means is that if, in this example, if we had 100 trades, over time you'll find that you're winning 60 and losing 40. Okay? Or if you break it down to a shorter number, 10 trades, you're winning roughly every 6 and 10. Okay, roughly. All right, so now it's a percentage, 60. How many people think 60% is good or bad? How many people think 60 is good or bad? Yeah, okay, it depends. Okay, Toby, that's a good answer. All right. Okay, so pretty split. I mean, a lot of people think it's pretty good, and some people think, well, it depends, and you're probably right because it's going to depend on your payoff ratio, isn't it? All right, some people think it's bad. All right. Do you think you can become a successful trader with a 60% return? Now, we're not talking about, don't get confused here by certain ads out there by people saying selling trading systems that say, oh, use my system, you'll win 80%. Here, I'll show you the results. And they show you the results, but they've cherry-picked the time that it worked so well. They didn't cherry-pick the times that it didn't, okay? Overall, okay, if you're winning 60% of the time, that's actually not bad if your payoff ratio is good, okay? So that's going to be the next thing we want to look at is the payoff ratio. So if we run over to this, all right, this is more of like, it's a ratio, it's not a percentage. So for example, it's your average winning trade divided by your average losing trade. So 300, if you were winning $300 as an average, but losing 100 as an average, then that's pretty good. And your payoff ratio is 3 to 1. Okay, does everybody understand that? Okay. Okay, good. All right, so that's pretty basic now. Now again, what I'm trying to do here is not overcomplicate stuff. All right, we're not talking right now about ROI, return on investment, how much time it takes to make a profit. We're not going down that road right now. All right, right now we're keeping it simple so you understand the core concepts in determining your trade size. All right, so now let's move on. Now that you know what your payoff ratio is and your win ratio, let's go take a look at a table here called the risk of ruin probabilities. All right, so if you had 10% capital at risk and you had on the left-hand side, you see all your win ratios over here and your payoff ratios are up here. Okay, so in this example here, let's just say we had a win ratio of 55 and a payoff ratio of 2 to 1. All right, your chance of going bust, the risk of ruin, the chance of going bankrupt is 0.2%. That's low. Even with a system that's just winning 55% of the time. because your payoff ratio is saving the day. Okay? If your payoff ratio was 1-to-1, okay, then notice that jumps up to 13, but because you're winning 5% more than a toss of a coin, it's still 13.2. And notice how the changes can change. When you go look at this 5-to-1 ratio, if you were 55%, it's basically impossible to go bust. Okay? So that's kind of an interesting table. Now let's take a look at another one here. All right, here's a 45% with a payoff ratio of 1-to-1, and your chances of going bust here are 100%. So our goal is to get the risk of ruin on our side by looking at or analyzing our payoff ratio and our win ratio. So when you're testing your system, okay, you're testing your trading approach, you want to keep these two concepts in mind. And this is where a piece of software that we have called the Trader's Assistant really comes to the rescue, because it's going to analyze your closed trades, which are the trades that are important, right? All right, and it's going to take a look and calculate this information for you. And if you're finding that one is good and one is not, let's say your payoff ratio is 2-to-1, but your win ratio is 4-to-5, then you have to look at things like entries where you're placing your stops and so forth. And you shouldn't be trading until you have the risk of ruin on your side. So that's where testing can come in on a trading approach. How many people have spent the time to test their approach? Or how many people, better question, how many people may have not understood actually how to test their approach? Now at least here, okay, you've got some concrete terms here and things to look at now when you go and take a look at your trading. Very important, okay? So that's one thing to keep in mind. All right, so again, now that we're aware that risk of ruin is possible, you need to implement this awareness into your money management strategy as well. And you need to also be sure that you're constantly looking at those two variables, the payoff ratio and your win ratio. So if you calculate and stay within your risk parameters on any one trade, it's difficult to go bust, okay? Risk control is based on the risk of ruin formulas, which use your actual performance to calculate your percent risk to arrive at the correct maximum trade size using the trade size calculator. So we talked about that. All right, now, one observation I've noticed when coaching a lot of students, and I coach a lot, is I'll know in a heartbeat if they understand risk control by asking them about their trade size. A lot of people will tell me, if they don't understand risk control, they'll tell me that they usually are trading the same number of shares, like 500 or 1,000 on every trade. And what they usually do is they change their stop so the losses don't get too much, but they always trade the same amount of shares. That's not the way to do it, because what you're doing is you're adjusting your stop so your loss is not that great, instead of adjusting your trade size and keeping your stop where it's supposed to be based on actual support levels in the market. You don't want to be adjusting your stop to things that are meaningless in the market by guessing, okay? So you want to be able to actually use stops in the market based on significance in the market, like support levels and so forth. Again, we could spend a whole hour just talking about stop loss placement, but it's something you need to be aware of and look at. All right, so here's the trade size calculator again, and you've heard me talk about the Trader's Assistant and how it can be used to calculate the percent risk that you put in here. All right, so that's just a quick example. Now, let's go on and get into the meat of things here. So I want to arrive at a couple questions. Now, on this particular example, all right, basically what we're saying, and it doesn't matter, again, if you're using the ART system or something else at this point, because risk control can be used on any system, anytime, anywhere. What you need to take into account here is the logic behind calculating trade size. So let's say, for example, we have an entry that we want to go long on this market, and this happens to be an old chart of Intel, and we want to go long at 26.99 because that's when prices break that resistance level. And if they do break that resistance level, then I want to put my stop one tick under this price bar here, which represents a fractal support area. So these are two fractals. So I'm trading within the fractals, okay? So the stop loss exit price is 25.45. So the risk is really the difference, isn't it, between the entry and the exit. We call that raw risk. So the next thing we want to do is actually calculate our trade size. So let's go ahead to our next slide before we go into all the numbers here and ask the question as such. You've seen the chart, so now the question is, what's your maximum trade size going to be? We have an account value of 50,000. You have a margin account of 50%, so that increases your buying power to 75,000. You trade using the 2% risk rule. Your trade entry is 26.99, and your initial stop loss is at 25.45, and your commissions in this example is $10. All right, well, if you have the trade size calculator, oh, that's easy. You just put them right in, okay? But now I want to go over the formulas that are in the trade size calculator. All right, so we're going to answer, one of these answers is correct. So let's go ahead and go to the next slide. There we go. Okay, so this is the next slide, and this is formula step number 1. So the first thing we're going to do is most simplest of calculations, and we're going to calculate the dollar risk that we can actually afford to lose on a account size that we're using. So in our example, a $50,000 account, if we're using a 2% risk base off, now how did we arrive at the 2%? It's taking into account our win ratio and our payoff ratio. So those things are already taken into account by this percent here. So based on that, we've got the risk of ruin taken care of, and 2% of 50,000 is $1,000. So we cannot afford to lose more than $1,000 if we get stopped out. So let's move on. What's the second part of the equation? Well, now we're actually going to be able to calculate your trade size. We're going to take that $1,000. We're going to subtract out the commission because we're going to get it as a net value, right? And the difference between the entry and the stop on this example is $1.54. So the raw risk is $1.54. We divide the amount over 154, and it gives us a maximum trade size of 642 shares with those variables. So if we go to the trade size calculator, which has these formulas built into it, we're going to put the 50,000 in here, the 2% is there, entry, exit, all the variables, and here's where it's going to turn out the results. Okay, maximum trade size. And so that's the answer, 642 shares. So you don't want to trade any more than that, because if you're stopped out, all right, that will keep your losses within the risk of ruin, so you're keeping your losses small at that particular point. That's how you check your losses. And of course, the answer now is going to be C, 642 shares. Now, let's talk a little bit more about another example and talk about buying power, so you understand when we talk about you can lose $1,000 or up to $1,000 on a $50,000 account with a 2% risk, but we haven't addressed buying power. So let's address that. If your stock trading account, again, is 50,000, and we have a margin account of 50%, so it brings the buying power up to 75,000, Your entry on this example is 91.47, 90.23, and our commission is 51. How much did it cost to make the trade? Is the next question. And this is easy. Once you have calculated the trade size, which is here, remember we calculated that before, 753 shares, you just multiply that by the entry price, because that's how much the thing is costing. So your actual buying power is 68,000. The reason why I bring this up is because a lot of people get confused and they think, okay, 2% of 50,000 is 1,000, so I'm only buying $1,000 worth of stock. No. That's the amount you can afford to lose, but you're actually buying much more. Okay? So in this example, do you think we're using margin? You betcha. Okay? You betcha. All right? So let's move on here. I got a quick group here. I like that. Now, before we go to the next example, this just gives you the answer. Before we go to the next example, I know a lot of people out there trade options. So how do you apply risk control to options, you may ask? There's a variety of different ways. If you are using 2% based off your payoff ratio and your win ratio as your percent risk, then you automatically already know that you can afford on a $50,000 account to lose $1,000, and that's okay. So if you're buying an option, let's say you want to go long on a stock, but you don't want to buy the underlying asset, you just want to buy a simple call, you could buy $1,000 worth of an option, and if that option happens to expire worthless, you're going to lose the $1,000, but no more. So right away, that's risk control using 2%. So you're okay because you're within the risk of ruin based on your win ratio and your payoff ratio. Some people, what they'll do is they'll use the trade size calculator, and if it's telling you 753 shares, they'll buy 7 contracts. And then what they'll do is watch it, and when the underlying asset hits the stop loss point, they'll exit the option trade as well, okay? And that'll give them about the same thing. Okay? Let's move on. Now we're going to talk about the futures market. All right, this time we're going to be trading the S&P E-mini. How many out there trade the S&P E-mini? Anybody? Good. It's a great market to trade. Actually, all the E-minis are great. You know, they're quick fills. They don't require as much cash as the larger contracts, and it's much easier to you know, scale out because you have more contracts to fiddle with. Okay, liquidity is good, of course. Electronic fills, the whole 9 yards, right, Ron? Okay, and trade crude, sure. Richard trade, you can trade. There are E-minis on just about everything now, so it's great. When I first started trading, the only E-minis were around were basically the NASDAQ and the, you know, basically the CME, NASDAQ and the S&P. But in any case, in this example here, we have that $50,000 trading account again. We better grow that, right? $50,000 trading account. The margin requirement is $3,500. We're trading using the 2% risk rule. Your entry is at 1088.25 per contract. Your initial stop loss is at 1085, so it's a long trade. Your commission round trip is $10. So let's calculate what's the maximum trade size. So let's go to our formulas first. All right, again, 50,000 at 2%, pretty easy, right? 1,000. The only thing we're going to add in with the futures contract is the point value, because we got to calibrate this thing for the futures market. So if you're trading a different E-mini or different futures market, you know, the tick values, the point value is going to be different. All right. So we actually, when you buy the trade size calculator, we have a PDF handout where we give you the different point values for different future markets. Make it easy for you. You can look it up online too. But in any case, same type of thing, all right? So, we take 990, 1,000 minus 10 because the 10 is the commissions. The difference between the entry and the stop is 162.5, which is 3.25 times 50, and it gives you 6 contracts. So there's your answer. And the calculator will do it for you in a nanosecond. Okay, very quickly. Notice here on the calculator, all right, you put it to futures market and you have to put the margin in and you get that margin amount from your broker. So if you're day trading a short-term time frame on the S&P, you may even have, of course, you'll have a better margin requirement if you've been with them for a while than you will if you're doing an overnight trade. Okay. Very good. Okay. Well, I got a sharp group here. Everybody's getting the answers even before I give you the answers. That's pretty good. All right. So let's move on here. And here's just the example of that one visually. So you can actually see the chart. Okay. Here's the $3 raw risk between the entry and the exit and the variables. So now, we give you the entry, we give you the exit. So now, once you have that information, it's pretty easy to calculate your trade size. This is what makes using this a very systematic and structured approach. You don't have to think too much. You can just make it part of your game plan. Kind of like when you go and put the symbol and the order entry, you just do this real quick first, and you'll be all set. And of course, here's the answer in red as well. All right, so now let's take a look at this one. All right, the next example, all right, if the distance between your entry and exit is closer than $5.75, what would your trade size be? I got to show you the chart first for you to answer this. Okay, so here's the chart. All right, so what I'm asking for here is, let's say our risk here is $5.75, the distance between the entry and the exit. What I'm saying is, if this pyramid happened to be smaller, or your resistance and support levels were closer together, what would that do to the trade size? Would it be larger, smaller, or the same? So if it was anything less than $5.75. So your risk would be smaller, your raw risk would be smaller. So it'd be larger, right? Okay. So this is how, the important thing to take from this is that the variable we solve for is trade size. That's going to change based on the fact that the 2% is a constant. That's not changing. It's the trade size that's changing. And that trade size is changing based on the entry and exits being different in terms of closer together or further apart. Now, what else could change the trade size, of course, is the account size. So obviously, okay, if you have an active trade in place and you started with $50,000, you have to subtract that amount that you used in buying power from the $50,000. So this way it keeps you from over trading as well. And there's our answer, larger, okay? Best thing to do with some of this stuff is to get a piece of paper and draw in entries and exits on your own and get used to that concept, okay? All right, now, one other thing Andrea is asking is about options. So again, on options, if 2% of 50,000 is 1,000, then one way of approaching risk control with a simple buying of the call or buying of a put would be not to exceed $1,000 of an option. So don't pay more than $1,000 for your options, okay? The other way to do it is Some platforms allow you to even track the prices, in other words, chart the prices of the premium. So if you can chart the prices of the premium, you can use the trade size calculator just like it was for the futures market and track it for contracts, okay? Have it solve for contracts. If you can't track the premium price on a chart, then you can use the trade size calculator, and when it tells you, for example, 753 shares to go long, you can buy 7 contracts. But remember, we also have our stop set on the chart, right, of the underlying asset. So when prices dip below that stop, you got to get out, because when you do it that way, you are not limiting your exposure like you would if you just bought $1,000 of the premium. Okay. All right, so this wraps us back around. A couple more things I want to talk about before we end here, but this wraps us back around to the formulas here. Download this in case you showed up late or you missed it. Here's the link. It's in the chat area. Go ahead and download this free money management article because it has the formulas in it. Okay, so you can do that. And we also give you, directions on how to do that, all that kind of stuff in there. All right, now, like I said in the beginning, I want to leave you with some immediate action steps. And what you can take away from this today is that it's easy and necessary to calculate your trade size on every trade. If you can get into the habit of doing that, you're going to be way ahead of the herd, because most people don't do that. So if you can calculate or get used to, make it a habit to calculate your trade size on every trade, you're going to be in great shape. It's going to force you to use initial and trailing stops as well. All right, we want you to trail your stops as well and use an initial stop. You're going to need the initial stop because that's going to be needed for inputting into the calculations or the trade size calculator. And of course, how do you do this once you have that is basically the formulas I'm giving you in that handout, all right, on the free money management article, and also use key levels of support. Look at how you're setting your stops, all right? I think it's important. What we do on the initial stop is that, for example, when we take a trade, before we take a trade, we know where we're going to get out of the market. You should never enter a trade not knowing where your exit level is. Who would have that problem? People that, for example, rely on indicators like the certain ones where you have, a crossover, maybe an RSI crossover or something. They enter when it crosses over and they'll exit when it crosses back over. Well, they're not going to know when it's going to cross back over, so they're going to have no idea where their initial stop loss is. So we don't want you to do that. We want you to have an initial stop loss in place when you take the trade. And that way you can be able to calculate your trade size. And then once the trade moves in your favor, then trail your stops. Now, we could do a whole course on stop loss placement. And when you buy our software, that's exactly what we do. So that's something that is very important to know as well. And I want to leave you with a couple things here. One is, by acknowledging both the good and the bad of what can happen in the markets, and by fine-tuning your money management system, you're really going to be on the road to greater prosperity. It's going to make a huge difference for you when you start taking into account trade size and calculating it on each and every trade. You always want to use risk control on every trade. Okay, that's really important. And if you want to pick up the trade size calculator, it's you can't get much more inexpensive than that, almost like a trip to Starbucks, right? So that's available for you. Gene's going to put a link in there as well for the trade size calculator. And if you hit the help button. And again, it looks a little different now. It's more rectangular right now. We updated it, and it also has a Forex button down here. But if you hit the help button, okay, it will take you right to all the instructions on how to use it. So it's pretty cool. All right, so that's it for today, and we also have contact information. Let me scroll that over here. Okay, so if you need to get a hold of us, info@traderscoach.com. You can reach us, and there's our sales and customer support number as well. And we are located in San Diego, and our website is right there. All right, so I'm going to go put this back on the page there because I didn't spend much time on that in case you want to learn a little bit more about the calculator. All right, so I'm going through questions here. And let me just see if there's anything that's pertaining to any of the information. Now, let me ask you a question. Did this help you? Did you find this kind of opened up a whole new avenue to how you look at risk control? Excellent. Good. Good. Because that's what we want to do. We want to try to make it interesting, all right? Because, you know, risk control can be kind of a boring topic. So it's got to be a little bit interesting. We strive to make it interesting, but at the same time, we also want to make it useful. So that's the purpose of this, and we don't want you to have a large loss if we can help it. All right, and this is how we can help it. Okay, excellent. Well, again, you all were a sharp group. Okay, really excellent group today. And I want to thank you for coming and taking the time. And don't forget, download that article too, okay? It has a lot of good information in it. And, you know, we'll see you back here next time. So, Gene, I'm going to turn it back over to you. I think I've answered everybody's questions. And again, thank you for coming, everybody. So, Gene, back to you.
Excellent, Bennett. And I have to say, it's, you know, the money management actually is pretty simple to implement. It's just a matter of doing it. So, I'm excited that everyone here had such good input and they all were participating because I think everybody is getting it. So great group. Anyway, have a terrific evening, and we look forward to seeing you next Wednesday and every Wednesday for Wednesday Night Live. Have a great night.